I'm Ryan Beaudry. I lead our consumer product and payments team as part of MasterCard Open Banking. Really excited to have today's conversation on a really important topic for many of us in the room, which is focused on fintech lenders and underwriting challenges and navigating what is a challenging time for many organizations. So why does this matter? So a few years back, the CFPB reported that 1 in 10 consumers or individuals are credit invisible, which limits their ability to have access to new financial services, access to technology, access to extend their lives in many, many positive ways. So the panel that I'm joined by today has really innovative solutions and experience in navigating this issue and this challenge across the board. So where we're focused on is directing technology in a positive way so that it can be a force for good. And that's what I hope you take away from today's panel, is how these organizations and how collectively across fintechs, banks, governments, that we're working together to really improve financial access and experience, to address the credit invisible and to address challenges facing inclusivity and beyond in the US and outside of the US. So with that, let's get started. And I'll turn it over to the panel for introductions. So Jason, let me pass it to you.
Sure. Hi, I'm Jason Capehart. I'm the head of data science and machine learning at Machine Lane, where we focus on providing fair and clear financial services for working class Americans.
My name is Haiyan Huang. I'm the Chief Credit Officer at Prosper. So Prosper does personal loan and card and HELOC. My team manages credit and fraud, machine learning models as well for credit card and personal loan business.
Hi, Christy Kim, founder and CEO of Tomo Credit. Tomo Credit is based in San Francisco, still a small startup. We started a company to really help immigrants and international students and any college students who have not yet had a chance to build credit score in the US yet.
Hi everyone, I'm Bhanu Arora. I am the Chief Risk Officer at Avant. Avant is a credit-first financial technology company that provides digital lending solutions, primarily credit card and personal loans, to the middle-class Americans. And yeah, that's...
Awesome. So as you can see, we're going to have a really good discussion today. So Jason, let me just turn it over to you as we pivot and focus on the current state of consumer lending, and just get your perspective on how you would describe the current state of consumer lending.
Yeah, so when we think about where consumer lending is today, right, I think about it in two parts, right? There's the consumer part and there's the lender part. And from a lending perspective, you think about where we might have been in 2021 or early in 2022, you say like, wow, like consumers, all-time great savings, all-time low debt, low delinquencies, what a great time to lend, and right, times are good, things are going great for lenders, and then, sometime middle of the year, it starts to be like, wait, the Fed said they were going to do what? And right, suddenly you can see in terms of what everyone is doing across the industry is right, pumping the brakes or maybe even slamming on the brakes because of uncertainty and fear about what the future holds, what the economy looks like, what's the state of consumers. Inflation keeps going up, how are things going? But I contrast that with what happens for the vast majority of consumers in the United States, where you see, well, wait, because interest rates are up or inflation's higher, what changes for them? Well, there are still emergency expenses, the car still needs to be fixed, medicine still needs to be bought, people still want to invest in their education and their job training, their future, and so, right, for them, they still need to find a way to make ends meet and to manage their cash flows and to be financially healthy. And so for us, as lenders, I start to look at that overall picture and say, well, we didn't, I don't, unless there's anyone from the FOMC here this morning, probably not. Lots of people here who would be very happy to share their opinions on recent events. But when we consider ourselves as lenders, I think that right, we don't have control over the $1 trillion that was put into the economy that led to some of the easy times for lending, nor are we controlling interest rates that are leading to some of the right challenges that we're having today, but it's a question of, okay, what can we do to keep our businesses afloat, if not healthy, and what can we do to help consumers to continue to move on with their lives?
And along those lines, so as we're focusing in on consumers moving forward and advancing, Christy, interested in your perspective on where we're falling short with credit decisioning today, and as a result, who's impacted?
Yeah, so where do we fall short? So I am from South Korea. So when I first tried to get an auto loan, that was more than 10 years ago, fresh out of college, I got rejected more than like 5 times. And I was very confused, like, why am I getting rejected? I have a job. I was working in investment banking at that time, and I had no debt, no personal loan, no debt. So I'm a debt-free high earner. Why am I getting rejected? So that got me into this rabbit hole of understanding consumer lending. And my biggest takeaway was that the industry has been advanced a lot in the past decade or so, but consumer lending still, it's pretty much the same. From the big banks' perspective, they still ask you to have a credit score, good credit score, if you want to get a good rate. And I thought that that is interesting because now consumers, especially young consumers, they have mobile banking data and they are willing to share their data. So my thinking is that why don't I try to help customers like me who do not necessarily have existing credit history in the US, but have great potential and verifiable asset, cash flow. So I started focusing on helping them. And I realized that this year, when market is uncertain and credit score is becoming more and more important from the traditional lenders, so I thought that it's a good opportunity for startups like Tomo Credit, who are trying to use alternative data source to bypass the strict needs for high credit score.
Awesome. And I think, Hyen, from your experience, you have a lot of background on looking at different data sources and creating better experiences based on that. Can you maybe expand around where you see some of the biggest opportunities to address the challenges that Christy just shared?
Yeah, actually, I just learned Christine mentioned a good point about the people who are willing to provide access to their bank account, because that's something among all the suites of alternative data that we consider, or the friction that we actually create. Because in either way, when we ask for additional information, such as, okay, can you log on your bank account so that we can look into your, so that we can fund you? Actually, that's the message. Even so, there's still people who are hesitating about like providing that or not. But in terms of the whole suite of alternative data we look into our underwriting and then verification strategies, we do look into what gives us a comprehensive view and about this person's full financial capabilities and affordability, because that means we not only look at, for instance, asking for bank account, because that still comes as secondary. If I look into other things and then the signals are strong enough to say maybe not something I can underwrite, given my price range, right? So this information, for instance, I'm sure many of you are looking into or already use them, are like look at the trend, look at how they appear in the other alternative finance, and also whether they're fraud signals, and also about the overall trend about their score changes or their balance changes or payment pattern changes. So all this all come together as a whole suite of things, allow us to see not just one snapshot view, okay, you're who you are. We also know what paths took you to this point.
Yeah, totally agree.
And it's such a core concept too, that individuals are more than just one number or one point in time representing who they are. And as part of, I think, what I've heard each of you say so far is it's defining and really creating this 360-degree view so that you can enable the right access to which I think, Banu, what I love about your company's mission is financially forward, to continue moving in that direction. So maybe explain a bit around how, with financial services, innovators can carve out a better path.
Yeah, I think innovation at its core starts with, first and foremost, the understanding of the needs of the customers that you're trying to create innovation for. Right? If you just create something that's really fancy that nobody wants, that innovation is going to die. So understanding the customer, I think we have so much proliferation of data now that everybody has access to, especially like with being digital. Using that data effectively to understand, like, what is it that your customer really cares about? Why do they want that? So it's not just about using the tools that we have to like manage risk, but using the tools that we have to actually put forth a product in front of the customer that they actually really care about. And getting a full picture of the customer, like all of those things are critical and important because lending is a slightly different business than just selling a product out there that's not a financial product, because the customer pays you back later. And right now you're giving them money, which is something that they care about the most. So so it's very important to then make sure that you're doing innovation on both sides, because you want to do it responsibly, and you want to do it such that you expand access, because that's kind of what you want to do as part of being a fintech lender.
Yeah. It's really important, and I think across a number of us represented, companies are in different stages of growth, and weathering the current economy can be challenging. So certain organizations are focused on investing for growth, other organizations are focused on stabilization, other organizations are focused on pulling back and really focusing in on solving for their core customers. So as we kind of transition and start looking into best practices in weathering some of the current challenges that we're facing, would love to get a bit of leveraging your past experience and then understanding how we can collectively move forward. And Christy, maybe I can start with you, in that Tomo has been a real pioneer on extending access to address some of those challenges. So as you look at underwriting and as you look at inclusion, what are some of the innovations that you've brought to market, and how should the audience start looking at different ways to address these challenges?
Yeah, so for us, I told my team that, hey, as long as we don't pull back in this market, that's winning.
Yes.
Because everybody is pulling back. And when market is tightening, that just means that big banks are stricter with their credit score requirement. So young customers like me 10 years ago, they are even more screwed than before because they don't have credit score. It was already hard for people like me to build credit over time and then finally get approved. It took me so many years to get to 750 to 800 credit score because I was busy. I was focused on building my American dream. I didn't really wake up every day stressing out about the credit score. Right? So my thinking is why it has to be so difficult and so much friction. And so one day I found out when I was younger that my credit score went down because someone stole my social security number, for example. So there can be so many hiccups, and so in building your credit score when you are young and fresh, and especially as immigrant. So my thinking is that, how can we make that frictionless and as easy as possible so they can focus on what's really important for them, like building their best lives here in the US and focusing on their career and building their American dream. So in this environment, I believe that it's a good time for companies like Tomo Credit to really focus on our initial mission, that we are here because we wanted to do things differently from big banks. And it's actually good time for us because we see the increase in organic traffic coming in because our target customers now they are getting rejected even more by major lenders. So they will come to us even more. So 2023, this year, we actually saw more than a triple when it comes to organic traffic coming to our platform.
Awesome. And in a similar future-focused model, Haiyan, you talked a lot about individuals and having more data and insights to inform some of those decisions. When you're looking at future innovation, how is data and insights shaping your organization and its future?
Yeah, I'm a statistician by heart. So when I look at data, I think about correlation. So what matters to me is thinking about whether the correlation that you have been studying over time through the historical trend, whether that still holds or not, given the recent all the volatility happening around you, like Christy mentioned about other people's pullback, that could potentially change the trend of certain people's inquiries or how they open certain things and how they build a balance. So I think staying nimble and then also thinking about the fundamentals are still the key. Doesn't matter what data you look into. I think most importantly is to understand, so what? And that so what part requires a lot of thinking because a lot of things are not linearly correlated with what the future performance would be, or even from what you have seen, the performance of before pandemic, during pandemic versus now, given the record high 16-year high interest rate, and also the rent, the CPI inflation. So all this translate to resilience level will vary. And then when you look at the data, you either choose to be super proactive or you want to be quickly reactive. I think as a lender, I would think being like really thoughtful about your methodology and then making timing works for you is the key. Yeah,
absolutely. And so similar, Bhanu, maybe going back to you and what you shared in terms of Avant and financially forward, could you maybe talk a bit around how you're focusing in on the future and enabling consumers and individuals and people to ultimately achieve their goals?
Yeah. So I mean, in these times, I think as Jason had started off with, and I think Christy also mentioned, like the demand from consumers is actually higher, whereas the supply of credit is coming down. So, there are two things here that I see us like focusing ourselves on. The first one is for the million-plus customers that we already have, right? Like, they are all good-intentioned, well-playing customers, but bad things can happen to good people in these times, especially with how high inflation has been. And what we need to do is make sure that we have one, like the ability to provide the support that these customers would need during this journey, as well as like have the right tools in place so that we can personalize and customize what the customers would want from us to meet their unique individual situation that they are having to go through, right? The second thing happens on the underwriting, and a lot over there is about the certainty of what we have seen in the past, right? Right. Even though right now the priors are different, and the performance is likely going to not be something that is similar to what we've seen, but there are correlations that you can like leverage from the data that you've seen, and then try to use that information to drive more certainty in what you are originating going forward. And with that certainty, then you can be there for these customers that actually are in the market right now, have gotten beaten down by the times, but are really good customers that actually need our support in these times.
Yeah, and I think that's such an important point when we think about these things and go through these changes and cycles, that right, inflation doesn't change right who your customers are, right? They're the same people, even if they're in a financially stressed situation.
100%.
And Haiyan, anything to add in terms of that point that was just raised in terms of the dynamic? While macro factors may have an impact on certain individuals, but they are still the same. How does data play into that as well?
Yeah, I'm sure Jason has a model to model it. But I think I like what Ranu mentioned about Banu, sorry, mentioned about from the historical data, it can tell you, and in terms of what the outlook is stressing out certain people more disproportionately than some other people, we can see almost simultaneously in terms of how they are seeking for credit, whether they're able to get credit, and how they are able to keep the payment levels ups and downs, right, to a certain degree. But I do have one silver lining I want to highlight as that we're not seeing credit is really in the breaking point. I think it's still far from that. And actually, overall, I think the trend is normalizing and then getting back to the more normalized level because the score inflation actually made the situation a little bit more complicated in the past 3 years. One thing I want to highlight is if you think about the lower income population, yes, they're stressed more, especially earlier time last year, inflation was like 10%, right? Yeah. That definitely puts some people off the cliff. However, if you look at the income raise, they're also leading the income level increase, 7%. If you think overall real wage is falling behind inflation, this population is getting a little bit more than average raise as well. So I think that's important point that we, as example, right, when we model things, we need to consider this kind of non-uniform kind of impact. But I'm sure Jason has it. Thank you.
So I agree with her point about the fact that credit is not at the breaking point yet. And that's what I've been telling.
Not.
Yeah. And that's what I've been telling like my investors at least that, hey, we go after mid-income to high income at Tomo Credit because when we approve someone, we need to know that they have stable cash flow, not the snapshot, but historically, more like holistic level. So when you think about mid-income, high-income population in the US or aspirational high-income customers, they don't necessarily spend less than before. Or they don't necessarily like in trouble. Because I think this time, the banking crisis, it's a little bit different from the past crisis in a way that average consumers, they are affected less than before, especially for mid-income and above. So my thinking was that, okay, for companies like Tomo and other lenders, it can be an opportunity if we figure out the way to continue to serve our customers when the big players are pulling back. And another interesting part is that now consumers are more sensitive, more self-aware of their credit score and knowing that they should have a good credit score because they don't want to get a mortgage now, but in a couple of years, when the market gets better, they want to get one. So they think that now is a preparation time for them. So in that sense, I think it really depends on which customer base you are serving. So if you are serving mid-income to high income, it can be an opportunity.
Awesome. And I'll tee this up now, and then we'll close out with a couple more questions for the panel. But should you choose to have a question, we'll take questions in two forms in a minute here. So one, scan for Q&A. It will pull up Slido. Feel free to contribute questions there. We'll also do live questions in the room. We were going to do it via a show of hands, but we can't see hands if you raise them. So what I might ask is if you do have a question that you'd like to ask live, if you could just come up to and queue up in front of each of the aisles, and then I'll just hop off and hand you the mic for a live question. So both of those formats we'll come to here in a minute. But Jason, your models were called out several times now. So one, I'm super curious around what secret sauce you might have. But beyond that point, are there any best practices that you would share with this team?
Yeah, sure. So, I mean, the secret is there's no secret. And as we've been talking about, right, there's this overall theme of, right, looking for data and expanding access, and you can hear that we're all trying to do very much the same thing. And you know, when I reflect back on right where we were almost 10 years ago at this point with alternative data. I see similarities to where we are now with open banking data. And at the start of the pandemic, Mission Lane as a team, we were trying to invest in open banking data and cash flow underwriting at that time. And we're thinking, gosh, if we had only started this 6 months earlier, we would be in so much better place for the start of the pandemic. I said, we're not going to do this. This is going to happen again, and we're going to need this for the next time, one of these cycles takes place. And so, where, I sit today is being, happy and seeing lots of innovation and improvement all across fintech in regards to using things like open banking data and cash flow underwriting, because it really does provide a whole missing piece of what's going on from an underwriting perspective that does create that 360 view, or at least comes closer to creating that view. And for us, when you think about the model aspect of this and how do you use all this data in an interesting way, especially as you go through these cycles, where I think is where people get really nervous about things like machine learning, is that for us, model monitoring and getting into how do you keep an eye on these things? How do you use data? How do you look at the way in which residuals are changing, or you're getting concept shift across different models and the features that go into it? These are the things that then allow you to know, should you be trusting your credit data? How do you interpret cash flow? How do you work with these things? And so I think that is something that is not new by any means, but something that we're seeing once again is important as we get through these cycles, and will be again in the future.
And you, in a way, touched on the first question that was asked from the audience, which is, I'll read aloud. Is there a risk that machine learning underwriting models that were trained on data over the past 10 years of low rates won't perform as expected in the current environment? Anything further to add from yourself or from any of the other panelists?
My one-word answer would be yes.
I will say something. I think really depends on many factors, but if you want to have point estimate, yes, redo it. No, but at least consider whether you need to add overlays. But then if you're looking at ranking order power, if you actually train a model with sufficient data and evaluate it out of time, and evaluated stability, evaluated how they perform with your most recent booked population, I think that's still doable. But if you rely on point estimate, because many things have changed, so you may need to adjust your model based on that.
Yeah, couldn't agree more with what Hyan said, because that is I touched on this a little bit earlier too, right? Inherently the customers have similar behaviors. They stay the same way. It's just more of how much stress is on them externally, and that changes. So we do need to look at complementing the model itself with some additional information overlays, as I think Hyan was talking about, based on what you see in the macroeconomy. Right, and I just wanted to go back to one thing on what Jason was saying earlier. When he was talking about his models, a thing that struck to me was innovators don't let a crisis go to waste. That's just it.
Yeah, that's a great point. Another question that's on the top of the screen here, which is so important around consumer transparency, privacy, and solving for that, is with the move to consumer permission data, how do you ensure you're getting a full picture of consumers' risk instead of just what they show you?
So I think that goes back to my point about we are seeing the whole picture, not just a snapshot. Because if you are just looking at the snapshot, it's easy to fraud lenders. Because you get to decide which snapshot you want to show to the lender. But for Tomo and all the companies here, we are looking at the holistic level, meaning that it's actually pretty hard to fraud Tomo credit. So don't try, please. So the way how I think about this is a common sense, high level way that we are trying to look at your entire picture. So let's say you are a student and we know that you might not have a job, so you might not have stable income, but we are looking for certain signals. And really, the game changer here is that customers are willing to share their real-time bank data. So millennial, Gen Z, we grew up with a mobile phone and mobile banking. So for them, they don't find friction in adding their bank account. So they are used to it because they all use like Venmo, PayPal, Coinbase, etc. So they are somehow trained to share their data, like permission-based. So for Tomo, it was easy. We started 5 years ago, and from the very beginning, we had to ask everybody to share their data. And we didn't really experience friction point from our user base, mainly because we target younger audience.
Yeah.
Okay. One thing I would call out is that whenever there is innovation in the market, and right now, like customer permission data, usage of that in underwriting is innovation. Like, you will see people that will try to take advantage of it. You will see people that will try to break the system, right, so to speak. And it's very important at that point, right, to create the right guardrails around like how you are leaning into this usage by like having an iterative process, like a test and learn strategy. And I think that goes a long way in trying to control your risk while still continuing to innovate and learn more from like the new tools that you have access to.
Yeah, I'm definitely with you 100% on the test and learn. That's something I think we benefited a lot through like a quick integration, quick test, and then quick learn. And also something else is about the full picture about consumer risk is either it's a consumer permitted data or traditional data, whatever data. I think our practice is we need to have some kind of cohort concept in mind because whichever data that you want to introduce, it's almost like you introduce a new dimension to slice and dice your data and to really look at how this helps you to pick somebody out from the cohort that actually will further differentiate their credit risk. So at least that actually same concept applies to fraud risk as well. So.
Thank you. Another question, still in the vein of alternative data, and while I'll modify the second question slightly as to not ask for a comment on FCRA positions, but maybe on the compliance side, how do you manage alternative data and compliance?
Well, so I mean, to me, when it comes to using alternative data and thinking about compliance, right? First of all, yes, let's acknowledge it's hard. It is a area best discussed with your compliance and legal folks. It's very difficult, but I think that there's an underlying ethical and moral approach to it that we can all take, which is about being able to look at the data and how it impacts the consumer, right? We all know about disparate impact. We all know a lot about our customers, and we're able to analyze whether these are pieces of data that increase discrimination and harm people and harm, in particular, the communities that are most marginal in financial services, or these things, and I think that we've all probably seen this with our usage of alternative data, that tend to expand access to these populations that give them a foothold, right? Like Tomo Credit is trying to do, and Mission Lane and Prosper and Avant are all trying to do to say, like, we can use these things to expand access to credit. And so if we're measuring these things and we're seeing that it is improving fairness in financial services, hopefully that's something that we can all eventually understand and get behind, whether we think about regulators or consumer advocates or industry experts.
Yeah, for my practice, between being innovative versus being compliant, I'll definitely pick the latter. So, so when we evaluate alternative data or do whatever, I need to think about what you're going to use the data for. If it's for credit decision, the data has to be FCRA compliant because every single attribute I put in the model, they need to be actionable, and they are disputable. So that's bottom line. But there are other types, for instance, you have to evaluate it because it does tell people apart. So in that way, then, we create that kind of a separation to tell you, okay, do you believe this person is who he claims as? Are there additional things you may need to ask to verify that? So with that, then, we definitely believe that's, I think, a safer, more sustainable approach, and then makes my job a little bit easier and safer. Thank you.
Thank you.
So the
Christy?
quick comment is, I think you pointed out really good part that we are trying to give second look to many customers who otherwise get rejected right away without any consideration. So in high level, we are at startups, we are trying to open up the credit universe and opportunities for people otherwise who are completely blocked. So in regulatory standpoint, I think that's a good context to for us to have that we are not here to cherry pick the best. We are not here to deny someone with this user permission-based data. We are trying to see if we can give second chance.
And as part of that second chance, and as part of the overall data profile around an individual, to close out on the question portion, can you maybe talk a bit around the role of the FICO score within your models?
I'll say for us at least, right? FICO is of course still the gold standard and the benchmark against things which are models and credit risk is measured, but right, it doesn't really play a role for us.
We still use FICO as a way to actually serve as a benchmark and then serve as, okay, how at least I compare with the industry benchmark. And also allows us to actually look at the through economic cycle kind of performance comparisons. So we use it mostly in that way.
Awesome.
Yeah, I mean, very similar on our end. It's not used in our modeling decisions, but we do use it as kind of given that there is 50 years of history, there are things that go into the FICO score that we don't know about. So we understand that and we appreciate that, and that's why we put in some criteria using FICO as kind of this is the floor. We don't want to accept anything below this. Right?
I forgot to mention one thing. We launched a card in December 2021. At that time, it was a new market segment. So in that case, FICO definitely was a must-have.
Yeah, and I feel like that's one of the things that I have to say as a machine learning person is sometimes it'll come off like I'm ragging on FICO. FICO is a different thing, right? FICO is trying to be successful at being all things to all people in all segments.
Exactly.
And right, at least for our businesses, we're focusing on something much more specific that we can be more tailored to.
Exactly.
So one quick note to that one. So when I am talking to non-fintech people who are not so familiar with the details, so they ask me, how is it different from how Tomo Credit is different from other companies? And I tell them that, well, if you give me 100,000 people or group of people in the room, I am able to rank them without FICO. That's how I try to explain what we do, even to the consumers, that, hey, customers, when you come to us, you don't have to stress out about the fact that you don't have 800 credit score. 800 or no score for Tomo Credit, you guys are the same.
Thank you. And as we wrap up, and think about the future ahead, maybe let's for each of the panelists leave us with your final thoughts on how to be resilient under current economic conditions, and then how to prepare for the future. Jason.
Yeah, I'll say for me, when it comes to resiliency, it's about taking a holistic view. It's about considering things that are often latent in our approach to credit, and like the macroeconomic picture and how things are working in local geographies. And for the future, I really think that a lot of how, as we've touched on, a lot of how we will unlock these new data sources and find ways to make customer permission data work is through fair and transparent machine learning. That's the sort of thing that allows everyone to gain trust that these are approaches that are better for everybody.
I'll say stay focused, disciplined, and be nimble, and enjoy the ride.
Good advice.
Yeah, I will echo that. Just know your target segment and then being able to really focus. I think that will be the key.
Yeah, I mean, I would just add, I think the be nimble part. I think resilience in the current times is a lot about being agile, right? And it's agile in both ways, like being proactive about planning for scenarios that could be happening, as well as quickly being reactive to what you see.
Awesome. Thank you. And on behalf of the panel, thank you for joining us today. Please join me in giving them a round of applause.
Thank you.